7 Singapore stocks on Forbes Best in Asia list. Yes, it's always exciting when local companies get recognized on an international level. And today we're going to dive into these 7 Singapore stocks that made the cut. And more importantly, should they be on your investment radar right now? Stick around as we break down some of these stocks and explore what makes them potential winners in future. Let's go. And before that, I'm going to cover one of them in my weekly newsletter as Stock Idea of the Week. So if you haven't done so, do join my free weekly newsletter where you will get tips on the US and Singapore stock markets, stock ideas, analyst reports, and many more. You can find the link down in the description box below. So without further ado, let's jump back to the video. For those unfamiliar, Forbes, they cover 200 companies selected from a universe of more than 20,000 listed companies in the Asia Pacific region with annual sales above 10 million and below 1 billion. So they are looking at more of the small to mid-cap companies. And on top of that, they have a composite score, right, which measure the debt, sales, and earnings per share growth over the most recent fiscal 1 year and 3 year periods, as well as the strongest 1 and 5 year average ROE. Okay, so aside from the quantitative criteria, they also cover qualitative screens, right? So they exclude all these with governance issues, accounting practices, and so on and so forth. All right. So now let's move on to the 7 companies under this Forbes Asia Best under a billion. Here are the 7 Singapore companies under this Forbes Asia, right? When I select filter by Singapore as a country, here are the 7 stocks that we have. All right, so let me just list down one by one. So first one, we have Aztec Global. Their sales is 667 million with 74 million income. Market value is 557 million. All right, next one we have the, I think construction or no, they are the distributor, right? So Chu Chang Holdings, right? It's a very small cap company, right? Market value only 56 million. Right, moving on, we have Credit Bureau Asia, okay, which is they provide these credit risk ratings for Singapore. Singapore is their main source of revenue, more than 95%, if I'm not wrong. Right. Next up, we have Delphi. Delphi is the chocolate maker. Okay, they are popular in Indonesia with their Dairy Queen and also their premiumization strategy, which led them to venture into Van Houten. Okay, so you see a lot of chocolate brands with this Delphi brand or the Van Houten brand, right? This is part of Delphi. Next up, moving on, we have agriculture foods. So a lot of investors may not be familiar with this stock because they are listed in Hong Kong itself. All right. So although they retail the eggs under Singapore outlets, they are listed in Hong Kong. But what's very interesting when I take a look at this counter is that it's trading at only 2 times PE ratio. Okay, so later on I will shift to Simply Wall Street to take a look at the overall of these 7 companies. Last 2 companies, we have Old Chunky. Okay, so Old Chunky, no need any introduction, right? So we are all very familiar with their pastries, their fried snacks, found in all the shopping malls in Singapore. But what's fascinating is that they have a relatively high profit margin when they are in the F&B industry. You know, F&B is pretty cutthroat. So their sales is 75 million, whereas their market value is only 66 million. So they are, like trading at below 1 time sales, which is, I think maybe there's more room for growth. I'm not sure. All right. Last but not least, we have Singapore Exchange, our monopoly when it comes to Singapore stocks, right? So Singapore Exchange, their sales is the highest as 875 million, whereas their market value is the highest also because it's a blue chip stock, 7.7 billion, the largest among these 7 stocks. And if you have enjoyed this video thus far, I will greatly appreciate it if you can help me to smash that like button, subscribe to my channel, and ring the bell so you get notified every time I release another stock analysis video. Alright, so what I have done is also to put all these seven stocks under this watch list in Simply Wall Street. If you don't have an account, you can sign up an account, a free account, okay, using my affiliate link down below. So you'll help to support my YouTube channel. Okay, but without further ado, let's dive into each of them. I'm not gonna dive into each one of them specifically. Okay, if you want me to do that, just comment down below the stock name, and if I'm free, I will do a separate video on it. All right. Okay, so now on an overall basis, let's look at the stocks. So first one we have Aztec, right? So trading at 94 cents based on Simply Wall Street, okay, discounted cash flow model, which is a black box, so I'm not gonna dive into it as well. So they gave a $1.75 fair value, so it means that it is 47% undervalued. But right now it's trading at 7 times P/E ratio, which I think is fairly cheap as well, as you compare to the whole market as a whole. And but the growth may not be so fantastic, 7.6%. All right, and but analyst target price is $1.22. Chu Chang is like a distributor, so I'm not gonna dive much into that because I'm not very familiar with the stock as well. The other company is Credit Bureau, is providing all these credit risk monitoring and the solutions. So what surprised me is this, you can see from the space, right? So Simply Wall Street, they do like analysis, overall analysis on the stock, like based on value, based on growth, and things like that. So only Aztec and Credit Bureau Asia, as well as I think Delphi, perform relatively well on all five aspects. Okay, so not very cheap, 18.6 times, but generally the business model is quite stable and defensive, like, if I'm not wrong. Okay, analyst price target $1.20. So there's a potential, upside for growth. Same thing for Delphi, 81 cents, and analyst target price is $1.08. Okay, so Delphi, I think P ratio is also quite reasonable at 9.2 times. So for agriculture, you can see that they are trading at Hong Kong dollar 49 cents only. So you have to divide by 5 times, right? So it is like Singapore equivalent of only 10 cents. All right. And they are only trading at 2.1 times price to earnings, not really covered by any analysts. All right, and it's because of that, no forecasted growth. All right, so if you want, you can go check out this stock by yourself using Simply Wall Street, because the past 1 year they have gained 143%. So if there, I mean, I don't know whether there will be potential upside going forward. You can take a look if you are interested. Oh, Chunky, very interesting. Although it is trading at 9 times price to earnings, based on the discounted cash flow model, right, of 61 cents fair value, it is around 18% overvalued. Okay, and last but not least, Singapore Exchange, $10 right now. The analyst target price is also around 10.60. Discounted cash flow model $12.50. So I would say it's fairly value at the moment. Seven stocks have shown great performance, and that's why they have made it to the Forbes Best Under a Billion list. But the big question is, which one is worth investing in? I'm gonna review my preferred number one stock in my newsletter this week. So make sure you join my newsletter below to find out more. So what about you? Which stock do you find interesting to dig more into it? Let me know in the comments down below. With that, if you find this video helpful for you, I would greatly appreciate it if you can help me to smash the like button and subscribe to my channel, as I'll be posting 2 videos every week. And I will see you next time. Thanks for watching, and watch my next video over here.